All right, well, welcome back to the session. We have now our entrepreneur track. Most of you know me from before. My name is Matt Bresnahan. I'm a partner at Wilson Sonsini, title sponsor for today's conference, and we're very happy to be so. So we'll get rolling in just a minute, but before we do want to recognize our generous track sponsor for this session, Phoenix Ventures. And I'll ask Brian Grigsby, President, and Nick Holm, Business Development Manager, to come on up and say a few words.
All right, for a little audience engagement, who here in this room is involved or interacting in some way with medical device development? Do we have any, or are they still filing in? I know this is an entrepreneur group. So Phoenix Ventures, what we do is, whether with small companies, small startups, or large corporations, we provide the toolbox to get medical devices into market. And whether that's generation 2 devices or early on initial generation devices, we try to be a one-stop shop for product development and process development, including the clinical builds, the validations and verification support, NPI, and even scaled manufacturing. We have office in the Bay Area as well as in Lehigh, Utah, and in Golden, Colorado. And we have offshore partners to help scale up manufacturing as our customers grow.
I thought we were going to do some jokes to liven things up. All right, I guess I'll have to go off a different script here. Phoenix Ventures is a 1345 manufacturing firm. As Nick said, we do everything from small volume all the way up through clinical builds. In our highest runner, we've done over 2 million parts. We have right now open molding capacity. I know with a lot of the shortages, people are struggling to find molding capacity. We have it. So if you've got some molds that you want to transfer, we can take it. Or if you need us to develop new molds, we can do that with our in-house tooling. Something really exciting for us is we're bringing in chlorine dioxide sterilization. So we should have our chamber operational this summer. And for those of you who don't know about chlorine dioxide sterilization, it's a replacement for EO. And so we're very excited about having that. So Nick and I will be here through the VIP dinner tonight and at LSI next week if anybody wants to catch up and learn a little bit more. All right, thanks.
Great. Thanks, Brian and Nick. I actually don't have any jokes either, but I'm proud that nobody's got slapped on stage so far. So we'll try to keep that up. Thank you, Phoenix Ventures, making this session possible. We're very, very grateful for your support. So for our next panel, Value, Create It, Protect It, Maximize It is the title. We have a slate of very seasoned experts from PricewaterhouseCoopers, PwC, and I'll allow them to take the stage and take it from here.
It's really too bad when you're going to leave the jokes to the accountants. And I've felt tall before, but being up here, I really feel tall, so I'm going to step down. We'll do it this way. All right, we're excited to be here with you at the summit today. So my name's Don Hulet, and I'm a managing director here with PwC in Salt Lake City. And I'm happy to be joined with 3 of my colleagues. And, as we thought about this and they came up with these great ideas on the way I should welcome them. And it was adjectives like distinguished and notable and esteemed and things like that. But, whatever fancy term they think they deserve, I'm going to put them on the back seat for a moment. And I'm going to take the stage. So one of the things I wanted to set the premise for was the nature of our panel today. So PwC is a global professional services firm. And one of the things that is interesting about PwC is, okay, great, we deal with Fortune 500 companies a lot of the time. However, over the last year, we dealt with over like 100,000 entrepreneurial and private companies. And it's our service and breadth of that service that we want to help share with you today. And with that concept of the topic that is the official title in the program of Value, Create It, Protect It, and Maximize It. So with that, I'm going to turn to my esteemed colleagues and have them introduce themselves. Adrian?
Yeah, hello everyone. Adrian Beamish. I'm a partner at PwC in our health industries, the life sciences practice, working mostly with entrepreneurial early stage companies and helping guide them through the journey from being private to acquisition or capital markets. So I work across the West region, again, biotech, medtech, and other healthcare type companies.
Brian Babcock. I'm a managing director based out of our Denver office in the health industry service. We've got approximately 75 professionals in Denver that cover the Rockies across our deals practice, which covers strategy through execution. I specifically focus on valuation, so valuation of these companies. Valuation for strategic purposes, joint ventures, collaborations, M&A, et cetera.
Tyson Woodruff, Managing Director with our cybersecurity practice based out of San Jose, California. I do cybersecurity for all types of companies in different industries. I've also started working quite a bit with startups, early stage companies, helping them understand really what's expected from an acquisition from the acquiring company and helping them prepare for that or for an IPO. So excited to be here.
And I think I will say, Adrian and I both have the long tenured, boring kind of experience growing up in the firm, but you'll hear some good stuff from Tyson coming out because he's got a less traditional path.
Great. So one of the things, just to initially poll the audience here to understand the perspectives that you all have. By a show of hands, how many of you are with a biopharma, med device, life sciences company as opposed to a service provider? Okay, good. And of that group, how many of you in the last year transacted an important event that you deemed as significant for your organization? Okay, a couple of you. And then the backdrop to that particular question is, how did you feel about the value? Was value achieved? And that's what we want to try to focus on today. Before I do that, I'm going to ask Adrian to give a little perspective, though, on as a service provider to the industry, the perspective around what's gone on with SVB and some of the things that we've seen over the last few days in dealing with our clients in that particular situation.
Yeah, thanks, Don. I mean, in some ways, it almost feels like old news at this point because it feels like there's been nothing else on the headlines for the last few days. Clearly, there was a lot of alarm late last week, and I think it's a view that a lot of that was alleviated over the weekend with the Fed stepping in. I think it's important to note, though, that we're not necessarily out of the woods yet. There's a number of complications still around SVB, and one of the panelists this morning alluded to this. It's not just the deposit accounts, which seem to have been secured by now, but a lot of companies have credit lines and debt agreements with SVB, and as was alluded by one panelist, SVB often requires that all or a certain portion of the company's deposit accounts are with SVB in order to maintain the credit line. So you have this sort of dilemma, this issue right now. Well, okay, maybe I want to move my money around and not have it all in SVB, even though it might be secured. Diversification is a good thing. But if I try and move it around, does my debt become callable because there's this covenant, I have to have my cash with SVB? And or if I move it around, do I still have access to a credit line? So, there's a number of complications like that companies are trying to deal with. I know a number of the law firms are putting out some guidance, which right now seems to be talk to your local SVB representative, whoever that might be, I don't know. But so you have this sort of thing, things are moving pretty quickly, but that's one thing where clearly we're not out of the woods. I think secondly, we're seeing with clients, even if you don't have an SVB banking relationship, you've got to try and inventory your relationships, your other business relationships. You could have customers. I know some of these companies are biotechs, but you could be medtech with some customers who might bank at SVB. How do you know their exposure? Do you have other vendors? What other kinds of ecosystem challenges might there be with SVB that could come to harm you your way? I think also following on from this, and again, we haven't heard the last of this, clearly there's going to be a heightened sort of scrutiny around banking relationships and more interest around this going forward. I mean, in the past, if you're a startup, you had your account with SVB and it was in T-bills and money market account and great, no questions asked. Now I think you're going to see investors start to ask, okay, we're going to put some money in. What are you going to do with that money? Where's it going to go? You're going to see board members ask a lot of questions. Auditors, we like to ask a lot of questions as well. So this is going to play out for quite some time. So it's obviously changing by the day and by the hour, but I would say, the events of the past few days, certainly it's not all clear and sorted out at this point. But Tyson, you got some from given what you do.
Sure. So a little bit more background. So prior to coming to PwC, former federal government agent. I worked for the FBI as a special agent. My area of specialty was counterintelligence, so I was a spy catcher. So my job was to work with companies to figure out what people were trying to steal, who was trying to steal it, and how they were trying to steal it, and find those individuals, prosecute them, kick them out of the country, or flip them and run them as double agents back against their security services. I did that for a while, and then I went into the CIA and went overseas, and I recruited assets, meaning I recruited spies, and we went and stole secrets. And we went and figured out what type of technical security companies had, and how to get around it, and steal whatever the U.S. deemed as important at the time. So I come from a less traditional cybersecurity background, but it was all around stealing secrets. And so right now, with what's going on with SVB, it's a ripe opportunity for these individuals to steal secrets from your companies. I mean, frankly, startups in this industry have two things of value. One is what you're creating, and two is the money that you've been given. And either one, people want. And so right now you have, because of what Adrian was talking about, in the fact that you're going to have to be moving your money around, it's ripe for things like phishing scams, for credential scams, for fraud invoice scams, and then for disruption of your supply chains. And so make sure that you have controls in place for each of those. And we're going to go into a little more detail later, but just know that right now you will see an uptick in attempts of scams. And so please make sure that, especially with around payments, that you have a process in place for verifying payments and the accounts where they're going to. And anyway, so one of the things that we're seeing is that individuals and entities are setting up websites to pose as financial institutions to provide startups funding with with great terms. And so please be aware those types of scams are out there. They're pretty common, and we're going to see an uptick over the next year or so. So as this falls out.
Great. Your stuff's more exciting. We're going to just hand you the mic. So with 2022 behind us, we know what kind of a year that was. Very challenging and interesting with some of the headwinds that we all dealt with. Earlier today, we heard perspectives from CEOs and investors as it pertains to the outlook for 2023. So Adrian, maybe from the standpoint of our perspective as a service provider to the industry, what do you see, or how do you think, or how do you see the deals market playing out in 2023?
Yeah, I mean, in terms of deals, M&A we would like to see, or we hope to see, come back later this year. I think there's still a lot of cash on the balance sheets of corporates and acquirers, so that is a good sign. There's the need for innovation at the large companies, so again, that's there. There's a large number of companies with great products or great technologies, but clearly valuation is being it's got to be one of the drivers, right? And I think as was mentioned this morning about that lag between public company valuations and private company valuations, I think you will see, particularly as some of these private companies maybe become more stressed in terms of liquidity, you'll see more acquisitions coming up later this year. Clearly, sort of private equity tends to do a lot of activity in these kinds of markets. Corporate VCs we mentioned as well, but I think that's where we see some of the M&A. I think if you look at medtech, specifically medtech, maybe some of those lower valuations will help medtech in terms of being more attractive to corporate partners, and maybe that will bounce back a bit later this year. I think with medtech, one of the challenges is that a lot of the medtech companies don't necessarily have novel devices, novel technologies, and so I read something that I think 1% of all FDA cleared, newly cleared FDA products over the last 2 years only 1% have been novel and required pre-market approval, right? And so you have this challenge in the medtech industry that how can you really drive value and growth if you're just doing sort of fairly modest incremental technology improvements. So that's something we do see companies with maybe services component, maybe connected data, various other add-ons, adding value among the value chain within the medtech industry. But that's, I think that's some challenges and opportunities there. Biotech, people think the biotech market is, and there's a couple of IPOs, we're working on some IPOs or companies planning for IPOs right now in biotech. You and I have worked on one, Don, right? So it's not completely dead. So okay, it's not as buoyant as it was, but it's not dead for sure. And there's companies who are planning for transactions later this year.
Yeah, and I think just to add on to that, Adrian, if we think about exits, right, an M&A or IPO or collaborations, right, there's been some talk earlier today around exits, right? Investors want to understand what type of exit opportunity is there when they do invest in your companies. So if we just look at where we're at from an M&A standpoint, 2021 was obviously record highs. We think that we're down right now, and we are relative to 2021, but we're essentially at pre-COVID levels of M&A activity when we're thinking about deal value and deal volume, right, the size of the transactions. There's still some headwinds, some significant headwinds that we're facing. Interest rates, inflation, there's still supply chain issues, right? There's still geopolitical concerns, and other things that do present some headwinds. But we also do have tailwinds, right? There is still capital out there, strong balance sheets on corporates. PEs have a ton of dry powder, right? And so there are opportunities, and the combination of higher debt costs, right? Money's more expensive. That will drive value down. And also thinking about your exits, if you have an opportunity to exit in an M&A, how would that exit be financed, right? That buyer, do they have the cash to pay, or would they have to go finance debt to do the acquisition? Because we've seen a number of transactions also fall apart because of financing concerns. So just be aware of that. And then on the IPO side, did you want to chime in on something?
Okay, go ahead.
On the IPO side, it's pretty staggering, right? 2022, I think there were 112 IPOs. 27 of those were, traditional IPO, with the rest being SPACs. 112. The year before, there was 951. The year before that, there was 431, right? So significantly down from the IPO standpoint. But as Adrian mentioned, we do see there's still some activity in the IPO market. We do expect that both the M&A market and IPO market will start opening up more and have more activity in the latter half of the year.
I mean, just to touch on that, I mean, in terms of the companies looking at doing IPOs, clearly there's not a lot of them, but the ones that are, they tend to be ones that are pretty well capitalized, pretty well backed by top-tier investors, and with a large addressable market. So those are ones, and so they're still good. There's also, there's a fair number of private emerging companies who have raised a lot of money in the last couple of years as well. So we're even seeing some acquisitions by, I'll say, emerging startups of other startups. So, being quite opportunistic. Maybe they're using equity rather than cash to do that, but we're seeing a few of those as well.
Okay, so a lot of emphasis or thoughts there on exits. So how can a company best prepare for a smooth exit, whether it's IPO, acquisition?
Sure, I can start with this one. So part of it is, due diligence, right? So if you are thinking about an exit, you may consider doing sell-side due diligence, right, to really supplement and support your financials. The buyers absolutely will be doing due diligence. In an earlier panel, there was discussion about transparency and being realistic about expectations, building trust in that process, right? So what I'm referring to is, historically, because there's going to be historical due diligence on, revenue, costs, et cetera, right? Are there costs that have been capitalized that really should have been expensed, so it's artificially inflating your P&L, right? That's going to come out in due diligence. Other debt-like items, if you're trying to hide like debt-like items on the liability side, that's going to come out in due diligence. Net working capital requirements, that's all part of the due diligence. And then also on the forecasts, right? traditionally due diligence is gonna identify how do forecasts look to historicals, how are they trending, is it the hockey stick approach? If there is a lot more growth in the outer years, like what's driving that? Is it a change in the business model? Is it new customers? Is the total addressable market, your share of that expected to increase, and why, right? Just having good explanations for some of that outlook, right? Because value is all based on expectation and outlook, right? So the more you can support that, the stronger valuation you'll get.
I think there's a lot of focus right now as well on multiple scenario planning as well, in terms of like, VCs investors will definitely kick the tires every which way in terms of trying to understand your models and the financials, and having downside scenarios in there is really important. So that sort of predictive ability, FP&A ability, I mean, as we said, managing the cash and the various scenarios is really important. I think IPOs we can talk about as well, even though I appreciate that not many people maybe think about IPOs in this market. I mean, if you look at an IPO, it's sort of a life event that takes 4 to 6 months to execute. And so we see companies wanting to not be completely hamstrung and distracted by that 4 to 6 month period, and trying to figure out well ahead of time what it's going to take for resources, people, processes, and technology, and how to get ready, and sort of map that out from a budgeting perspective and just in terms of an organizational planning perspective as well. So that's something that we see companies typically look maybe 18 months out, because they can't necessarily determine when the window is going to open for them and when they can complete a transaction, could be even an acquisition transaction, wanting to be ready for that as well. So this does create some time to think and sort of do some planning around various scenarios.
And when we're talking about an exit event, if you're talking specifically about being acquired by a different company, what we're seeing more and more is, as part of this due diligence, we're seeing a cyber due diligence also. Because frankly, what you're bringing to the table is some sort of technology, some sort of intellectual property that is unique, or is maybe a disruptor to your industry. And companies want to make sure that they're actually getting value for what they're paying. And so they want to make sure that IP, that technology, has been protected. So we come in with a cyber due diligence where we're taking a look at what have your security practices been around your data. Have you been protecting your information, your IP, your data, in a way that maintains the value of it for the acquiring company? And so please be aware that usually, and the reason why I'm here is because typically cyber is thought of last, right? When you're looking at an exit event, you're thinking of the financials, and usually you're not thinking about cyber because most companies in an early stage don't have the money to invest in having a chief information security officer. Cyber is usually thought of as last. What we're seeing, though, is that more and more with these cyber due diligences, that it actually affects your valuation and it affects the exit. So please be aware that companies, we work with the largest private equity companies who do a lot of acquisitions. They have large portfolios of companies. They do due diligence for cyber every single time now. So be aware that it's becoming much more common, and so you need to at least come to the table with being able to demonstrate how you're protecting your intellectual property, how you're protecting your technology. Please understand, they understand it's not going to be like a robust cybersecurity plan. They get that. They just want to see that you're doing something. And we can talk a little bit more about what that looks like in a minute.
So we covered some of those steps for a smooth exit. Now the concept of what about maximizing value?
Yeah, I think it was in the early year plenary session. Was talking about up rounds in the past. Like, are you having an up round, or is it down round? Is it flat, which is now considered maybe an up round, right? Like, so. So where are you on your kind of company continuum across from initial thought to commercialization, right? The further value is impacted by risk and return, right? It's plain and simple. If there's a ton of ambiguity, uncertainty associated with the product, right, or the commercialization, who's the customers, the total addressable market, if there's issues around that, that obviously has a negative impact on value. The more you can advance the company towards getting approvals, FDA approvals, and a plan for that creates value. The closer that you can get to realizing future cash flows, and that those cash flows are estimatable and determinable at some level of comfort, right? That is value, right? And so the value is based on expectation and those returns that can be generated from those future estimates, right? So there's no magic formula on the value, but being able to reduce risk, you know, and really understand the total addressable market and how you're going to achieve your portion of that, it would be critical with investors, other potential M&A activity, or, you know, potentially future IPO.
Maybe you should talk about the different types of models that we see in terms of cash flows and otherwise exit models that we typically review and deal with.
Yeah, so obviously, one thing that you may be doing already at your companies is issuing, you know, equity as compensation to your employees, right? When you're thinking about that, that has to be valued, right? A firm needs to value that, right? So, or the company, right? And so when you think about that, the typical models that are used are, you know, future cash flow models. There's probability expected weighted return models. That's acronym is PWORM, right? Just to forecast out different types of scenarios, right? Like, what could be my value in an IPO? What could be my value in an M&A? What if I stay private, right? And you can think about all these various value scenarios, probability weight them to come back to kind of a value estimate, right? So there are different models that we use to think about value and potential exits and the value that's created in those exits, but they're usually probability weighted, you know, future forecast type discounted cash flow models that we look at.
Sure. For maximizing value from a cybersecurity standpoint, there's a lot that you can do, but especially for early stage companies, what it comes down to is really, do you understand what's most valuable in your company? And do you have a basic plan in place to protect that information, that technology, and then respond when something happens? Because inevitably something is going to happen. Having those three things in place and being able to demonstrate that will go a long way in providing a lot of confidence to the acquiring company. When you're looking at kind of what areas, first is I'd say take a look at the data that you have and your data classification. So taking a look at data classification means that you actually understand what's most important within your company and then classifying it appropriately. That also includes the systems that are associated with that data, and that also includes unstructured data. I know that in this industry, and typically with early stage companies, there's a lot of collaboration that goes on. The challenge is that with collaboration comes ease of access to data, and especially on collaboration and sharing sites with unstructured data, super easy way for somebody to come in and steal a ton of information. So that would be the first one. The second one would be then privileged access, is taking that data classification and then making sure that you have privileged access that's in accordance with how you classify that data, and then finally having a culture of security. And what I mean by that is most companies that I've worked with in the past value collaboration over security, and so really don't. They consider security as a hindrance to progress. But if you just incorporate some security principles into your company, an awareness of these things like phishing scams, fraud scams, payment fraud scams, things like that, having an understanding of that within your company and having some basic processes in place to make sure that when something happens, your employees know what to do and know where they should go for help immediately, that'll eliminate about 90% of the problems that you're going to have at your stage. But it also goes a long way in ensuring that you're safeguarding what's most important.
So let's pause right there before continuing with some of our staged questions. Are there questions that you would like to ask at this point of the panel before we run out of time?
Cybersecurity insurance is an interesting one. It's changed quite a bit over the past few years. And so with this specifically, I'm not sure exactly what they're asking for. Probably have to sit down and talk to them about what they're most concerned with. But in general with cybersecurity insurance, what you're going to find is that you are going to be paying higher and higher premiums for less and less coverage. So be very specific with what they want before you go out and try to find the appropriate cybersecurity insurance, because it's changed a lot because of the uptick in attacks over the past, especially during COVID. There's been an increase in attacks, and because of that, the cybersecurity insurance companies, the policies that they're putting out will cover less and less, but they're costing a lot more. So be very specific. And unfortunately, I don't know a whole lot about the insurance side of things, but that's one of the trends that we've seen. So.
Yes.
Cloud data and security. Google login, right? That like some of our lowest end security. How do you protect that? Because you're going to get a lot of data on the cloud. How secure? How permanent should that be?
Actually, I think if you're already leveraging the cloud in those ways with Google, with AWS, I think you're quite a bit ahead of a lot of companies that we've worked with that are making the transition to cloud security. The reason why is because you have the AWS security, you have the Google security suite that's already kind of in place when you start leveraging the cloud. So in that sense, you're already steps ahead of companies that have to make that transition over. So I wouldn't be too paranoid about it. Obviously, there's a lot you can do around cloud security, but for early stage companies, if you're already there, I probably at least feel a little bit more comfortable, and then we can talk more specifics. If you ever want us to come in, we can talk more specifics around, what type of security you're employing and take a look at what you're already doing. But if you're already there, I'd say at least feel semi-secure. So, yeah.
So, some of this stuff costs money. Great ideas, but how would you suggest that a company manage the cost of and the balance of all of this with limited resources that people, funds, and all that?
Yeah, I mean, as we said here, is that the business and the innovation and the progress in R&D and revenues, that's what drives the value. So it's as you approach an exit event, it's try and have a balanced approach. I think by doing this plan 12, 18 months out, you can look to say, okay, where are the gaps? Where am I strong? What are the regulatory and legal requirements that I need to move towards, and how much effort is that going to take? And then what are those other things I need to do which may not be a legal requirement, but certainly if I don't have these in place as day one as a public company or in front of a potential acquirer, then I'm going to risk value in other ways. So I think there's a staged approach. Some things can be done very late on. Other things, maybe you want to get ahead of. I think common to all types of transaction is some kind of financial health and hygiene, right? And processes and controls. Doesn't mean you need to go full-blown Sarbanes-Oxley, but it does mean that, okay, having accurate, timely financials, good data, audits, for example, again, with some of these company failures that we've seen, I think it's probably going to be an increased requirement for companies to get audits done earlier, right? And so, there's you can put yourself in a good position by having good reporting. You don't need to spend a lot of money necessarily on early systems if you have a pretty simple business, but getting ahead and getting audits done, because they can be one of the bottlenecks in an IPO or an acquisition.
Yeah, and I think maybe to add on top of that, since my purview is really around financial modeling, forecasts, et cetera, understanding your cash burn rate, right? Like how much are you spending, not even a month, like a week, right? Understanding what your cash flow situation is going to look like going forward. I was speaking to a client and plan ahead, right, for that next fundraising, right? I think in the earlier session it was mentioned also, when you close one round of financing, already have the next one kind of lined up, right? Or work on getting it lined up. So I was talking to a client earlier this week actually, and they had planned it out really closely. So by the time they got their round of financing, they only had $10,000 left in the bank, right? And so they had planned that all out, so they knew exactly what their cash balance would look like over time. So making sure that you are budgeting, understanding your cash burn, and forecasting that out.
And then, like I said before, very basic for cybersecurity, because I know that we're typically the last to be thought of with this, and so really it's data classification, privileged access, and then building up a basic culture of security where you're, an awareness within your employees of what bad looks like and what to do when it happens. And then having an advisor on the outside that you can call. That really should be a response plan for most of you. And typically, I mean, I'll be frank, typically PwC has not been priced to support an early stage company. We've been too expensive. One of the things we've been working on is really a very tailored service for early stage companies where we can come in and just be an advisor, and then you guys can do the implementation, but at a very basic, at a very basic level, so that we can grow with you. The reason why is because we have the benefit of working with so many companies from so many different industries and so many different private equity companies that are purchasing early stage companies. We know what they want, we know what they're looking for, and we know what you should have in place. So if we can act as an advisor for you, as an advisor along the way at your different stages, one, we can do it relatively less expensive than we have before, but two, it'll actually ensure that the value of what you have maintains its security along the way.
Good. Other questions that we could field before we call it a wrap? Okay, we'll call it good.
Thank you.
Thank you all. Great team.